Everyone thinks that options trading is extremely difficult to learn. In this under 10-minute video, I'm going to break down everything that you need to know, highlighting the best strikes to trade and breaking down a few simple things about options. Enjoy. So first things first, I want to break down what can you trade options on. Options are listed on a majority of mega cap stocks and large cap stocks and mid cap stocks even. So in the Thinkorswim platform, which is this platform I am on right here, the easiest way to know if a stock has options is just go to trade, and then if it does have options, it will bring up a big chain like this. And that's how you know that there are options listed on this. Otherwise, it will say there are no options available, and that means there aren't any options to trade on it. So essentially what options are they're just a leveraged tool that you guys can use that are much more volatile than the underlying, and they allow you to take advantage of a stock's movement with a smaller amount of capital. Let me just break that down really quick to show you what I mean by that. So if we go in and let's say we want to do percent change, okay? If you're looking at something like, let's go to Tesla, for example. Okay, if we're looking at Tesla, it moved 2%. So unless you have, say, like $100,000 in your account or $100,000 on this position, you are not going to have any meaningful movement at all. Like, you need a lot of capital to trade. However, let's go into something like this one right here that went up 17% and it was only $365. And don't worry, I will break down how to read that price and how to select the best strike price. So they give you the ability to be able to trade a position with much smaller capital. Now, when we're looking at this, I typically will trade the closest expiration here. So a weekly expiration, which in Thinkorswim is just going to be the one that is the closest expiration. So for all of my trades that I will be taking this week will be on this first expiration here. The reason being is they are the most volatile, so they allow you to take the most advantage of the move. Now, I will note with the increased volatility on these weekly contracts, it does come with some risk, right? Anytime you're increasing volatility, you're increasing risk. Now, the basics here, and I'm just going to cover a few simple basics, and then I'm going to go into which strike prices are going to be the best to trade. So, a few simple basics. You have calls on this side. So, calls are if you think the stock price is going to go up, or you're bullish, or you have puts over here if you think the stock price is going to go down, and then you are bearish. Now, when we come off of that, the next thing you want to note is the strike price. So you can see all of these different strike prices right here, like a 215, a 217.5, a 220. This is essentially if you're holding until the expiration, which in this case would be the 13th of September. If you're holding until that expiration, what do you expect the price to be near? And then selecting your strike price accordingly. Now, one thing I would also note is when you see these prices here, it's not, so if it's 365 by 375, it's not $3.75 for this contract. Anytime you're looking at an options contract, you have to multiply the price by 100. So this would be, say, a $375 per contract on this particular strike price right here. So that is another thing you have to know. Now, for choosing the best individual strike price, I typically will trade 1 to 3 out of the money or at the money. So 1 to 3 at the money or out of the money. And how do we note that? So that is going to be, you guys see where this changes from purple to this black area. The first one underneath that right here is this contract right here, the first one in the black. That is going to be at the money. And that is going to be the best contract that you can typically trade that will have the best movement and the least amount of decay on that option contract is going to be that 217.5 call in this case, because it is right here. It's the first out of the money. Now, what if we go into puts? We would be trading the 215 because this is the first one in black and this is the first one at the money here. So at the money contracts, like I mentioned, they move the best, they give you the best risk parameters and the least amount of decay, and they typically, this is very key, they typically have a lot of volume. And when you're selecting option strike prices, this is a column you want to note. Because when you're entering a position, so let's say we're entering this 217.5. So let's say we want to buy this contract. Well, buy it at, let's say, buy it at 470. Well, for us to be able to buy this individual contract, there must be a seller. There has to be a seller out there. Otherwise, we won't be able to get into that position. So if we're having a contract that trades 41,702, the chances of us getting in and out very quick are very high because we've traded almost 42,000 contracts on the day. Now, what about if we go into something that traded 726? Now what could happen is you go to buy this right here at, say, this one's at like $1,500, and there's no one to sell, so you'll just sit there with an order trying to fill, and you will never fill it. So the thing that you have to note is you want to trade contracts that are going to be very liquid. And my general rule of thumb is I want something over at least 1,000 within the first 30 minutes, ideally 10,000 if we're trading within the hours. And something like mega caps like Apple, Amazon, Tesla, and all of them will provide you ample liquidity. But if you're trading names like CRM or CrowdStrike or all of these other names, you want to look at the volume, because the last thing you want to do is get into a position, you buy it, and you get filled, and then you're trying to sell and there's no one to sell to, and you're just stuck holding on to that position. So volume is going to be crucial. Now, when I say 1 to 3 at the money or out of the money, I am totally fine with trading. So this would be 1, this would be 2, and then this would be 3. Typically, these 3 right here will give you the best movement because they are going to be close to the option price and the price of the stock. What happens is if you trade way out of the money here at this 232.5, well, now Tesla has to make $20 a share to even get close to your price. So unless Tesla makes a drastic move, these are going to decay heavily. And you can see this even by the percent change. This contract's down 20% today, while all of these are up 25%. So it's something to note. You want to try to stay as close to at the money as you can. Now, the one thing I want to note and quickly break down too is people will say, okay, if I've traded an individual stock and it goes up $1, I know how much I'm going to make. But how much will I make if I buy an option? And I want to break this down quick for you guys. That is going to be referred to as the delta. And what the delta is this refers to how much your option contract will move per $1 move in the stock. So if you're trying to calculate how much money you'll make on an option contract, that's the easiest way to do it. So hypothetically, Tesla's at 216.27. So let's say Tesla goes to 217.27. So it gains $1. If we were trading this contract right here, we can expect to gain a 0.50. So remember, if it's a 0.50, we have to multiply it by 100. So for every dollar, and let me do that over here. So 0.50 times 100 is going to be $50. So every $1 Tesla moves, we can expect to gain $50 per contract that we have. So understanding the delta is going to help you understand how much that option contract is going to move. Now, one that I commonly see many people mess up is they don't take into consideration theta. And theta is going to be your overnight risk. So this is how much these option contracts lose their value overnight, and something you guys should note. Now, if you're just day trading like me, you don't have to worry about this, but when you're swing trading, this is something you want to know. So this individual contract right here at minus 0.67, so minus 0.67, remember we have to multiply that by 100, you're going to lose $67 per contract on this option overnight because the time value decay. So you want to really note this theta decay because you can say, well, oh, Tesla opened up flat tomorrow. Why am I down on the position? That is going to be exactly why. One last thing is what I like to do is a scenario where when to go way out of the money. And let's go into more of these option contracts here. When do you want to trade something like a 235 or a 240 call? That is a very good question. So when would we want to do that? Is when you are predicting a big move and your target is really far from where we currently are. So say you enter at 216 and you think Tesla can make a massive move today into 230 to 235, then I would consider taking these out of the money, knowing that they have an increased risk. But if this trade actually hits and it hits that target, the payout will be massive. So you select in farther out of the money only if you have conviction that the stock is going to make a big move that day and the technicals are pointing to that, or if it has an event where you think the market can move that fast and that far, then you do that. Otherwise, stick to 1 to 3 out of the money or at the money, and that is going to be your best bet. As always, if you have any questions, please feel free to leave them down below. And if you need any help, please reach out to us via Instagram or down below in the comments. Thank you guys, and I hope this video helps.